Hey everyone, welcome back to Corporate Decoder, the place where we expose the real story behind the corporate jargon. In this latest filing, we found a company that seems to be going through a major pivot, especially after a recent IPO. Well, brace yourselves, because this report is packed with details that might surprise you before we dive in if you love getting straight to the heart of corporate filings. Understanding what the numbers truly mean, make sure you are subscribed and have notifications turned on. We also have a fantastic Discord community linked in the description below where we break down these documents together, so consider joining us there. Alright, so we are looking at A.C.C.O Group Holdings Limited and their recent annual report. This is essentially their checkup after a year in business as a publicly traded company, and let me tell you, they've had quite the journey. This isn't just about numbers, it is about a company restructuring itself and getting itself ready for the big leagues. The first thing to note is that this is a Form 20-F. Their annual report for the fiscal year ending the 30th of June 2025, and it tells us they are registered with the US Securities and Exchange Commission, or SEC. They are a non-accelerated filer and an emerging growth company. This means they are on the smaller side and have some flexibility with regulations, which is common for newer public companies. Now for the juicy financial bits, looking at their consolidated balance sheets, as of the 30th of June 2025, they had total assets of about $3.9 million. This is up from $2.6 million the previous year, which sounds great, but let's dig a little deeper. Their accounts receivable net was $293,599. They also separately track accounts receivable from related parties, which was $11,265. This distinction is important. It tells us they keep close tabs on who owes them money, and whether that money comes from their regular customers or from companies connected to their own leadership. Now check this out, their restricted cash was only $886 as of the 30th of June 2025 compared to over $915,000 the prior year. That is a massive change. It means a huge chunk of cash that was tied up is now likely available for operations or growth. It is like a big hurdle cleared. This deferred IPO cost number is interesting, $750,000 in 2025 for costs related to their stock market debut. This makes sense as they are a newly public company, and these are costs that will be accounted for over time. Their total liabilities stood at about $1.7 million in 2025, which is up from $1.5 million in 2024. That is not necessarily bad, but when we look at their equity, it paints a clearer picture. And here is the shareholder equity part as of the 30th of June 2025. Their total shareholders' equity was about $2.1 million. This is a significant jump from about $1.1 million the previous year. This increase largely comes from retained earnings, suggesting the company is generating profits and keeping them rather than distributing them all. This is a positive sign for Reinvive. Statement. Let's look at their income statement to see how they got there. Their revenues for the year ended the 30th of June 2025 were $4.85 million, which is a good increase from $4.31 million in 2024 and $3.66 million in 2023. The company is growing, and that is always a good starting point. But look at their cost of revenues. It rose from $2.03 million in 2024 to $2.45 million in 2025. That is a substantial jump, and it is eating into their profits. This brings us to their gross profit margin. It dropped from almost 49% in 2024 to around 44% in 2025. This means that for every dollar of revenue earned, they are keeping less as pure profit. This is a critical trend to watch, especially for a growing company. Their operating income actually stayed almost flat year over year at around $1.05 million. Even though revenue went up, this is largely due to the increased cost of revenues we just discussed. The company is spending more to earn its money. Interesting here, they significantly cut down selling and marketing expenses by about 26% in 2025 compared to 2024. This suggests they might be focusing less on broad advertising and more on organic growth, or perhaps they found more efficient marketing channels. However, their general and administrative expenses saw a big jump by 26%. This is likely due to higher rent and staff-related costs as they expand their operations. And that is not necessarily a bad thing if it is fueling growth. Despite these shifts, their net income remained pretty stable at around $1 million in 2025. This shows resilience, but the slipping gross profit margin is still something to keep an eye on. Now onto cash flow. This is where the rubber meets the road. Their net cash from operating activities was a very healthy $1.5 million in 2025, up from $1.1 million in 2024. This is a strong indicator that their core business is generating plenty of cash, and that is a great sign for financial health. And in financing activities, we see a large outflow of $1.1 million in 2025 and $882,000 in 2024. This is primarily due to repayments to related parties and costs associated with their initial public offering. Basically them sorting out their financial structure after going public. Now let's talk about the risks because every company has them. And Acco Group Holdings Limited is no exception. They operate in a highly competitive market for corporate secretarial accounting and IP registration services. The worry here is that these services aren't always recurring, meaning they have to constantly find new customers or hope existing ones keep coming back. The report highlights the intense competition and their reliance on professional relationships. They also admit that competitors might have significantly more financial resources. This is a big factor for any business trying to grow. And then there is the brand recognition part. They know their reputation is key, and anything that tarnishes it can hurt them badly. This is why regulatory compliance and data security are so vital. A major theme is the potential influence of PRC laws and regulations. Especially given their operations in Hong Kong, the report repeatedly calls out the uncertainty surrounding these laws and how they could impact the business and the value of their shares. This is a significant geopolitical risk that investors need to be aware of. Another big chunk of risk is around their auditor and regulations like the HFCAA. This is a complex issue, but basically if the US regulator, the PCAO, can't properly inspect their auditor, due to foreign government rules there is a risk. Their shares could be delisted from US exchanges. This is a major concern for shareholders. On the strategy front, their mission is clear: to empower businesses with excellent technology-driven corporate services. They want to be the go-to partner for compliance and growth. This is a solid mission statement, but translating it into reality is the challenge. And they are talking about using artificial intelligence AI. They plan to use AI products from third parties to automate processes like data compilation and financial statement generation. This is a smart move to increase efficiency and keep costs down, especially if they can leverage existing tech rather than build it themselves. A key growth strategy is expanding into the US market. They see opportunity there and plan to set up new branches and offices. This is ambitious and will require significant investment, but could open up huge new revenue streams. Let's look at their services: corporate secretarial accounting and IP registration. These are their core businesses, and they are seeing growth, especially in corporate secretarial, and IP services accounting remains steady. The breakdown shows corporate secretarial services are their biggest revenue generator at over 60%. This segment alone brought in $2.9 million in revenue for 2025, which is a good increase from the previous year. And their IP registration services saw a significant jump of over 31% in 2025. That is a promising sign of growth in a specialized area. They have a good amount of clients, over 3,900 in total spread across Hong Kong and Singapore. And importantly, no single client makes up more than 10% of their revenue. This client diversification is a strength as it reduces their reliance on any one customer. So what is the overall picture here is my take. Acco Group Holdings Limited is a company that is clearly in a growth phase. They've restructured, gone public, and are investing in technology like AI to stay competitive. The expansion into the US market is a bold move that could pay off big time. However, their falling gross profit margin is a red flag. They need to better control their costs. As they grow, the reliance on international regulations, especially concerning China, also presents a significant risk that should not be underestimated. The auditor inspection issue is also a serious concern for any US listed company with a non-US auditor. They are doing a decent job managing their cash flow, which is crucial for a growing business, but the increasing administrative costs need careful monitoring. It will be interesting to see if their AI strategy and US expansion can offset these increasing expenses and the competitive pressures. Overall, Acco Group Holdings Limited is a young public company with potential, but also significant challenges to navigate. The next few years will be critical to see if they can capitalize on their growth strategies while managing the inherent risks in their operations and the global regulatory landscape. What do you think about this filing and the company's future strategy? Drop your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the world of corporate finance. And remember, our Discord is linked in the description if you want to join the conversation. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.